Thank you for being here today for this conference. I'm Ricky Revesz. I'm the director of the ALI, and I'm delighted to welcome you. I'll just say a couple of words, because anything I say will detract from the substance of the event, since you're all experts in this area and I'm not. But what I do want to say is that the reason we're all here is because Dan Schwarcz from the University of Minnesota wrote a bunch of very good articles. And as a result, the ALI selected him as a winner of its Early Career Scholar Award. So this is an award that the ALI gives every 2 years to 2 early career scholars who've been on academic tenure tracks for 10 years or under. It's actually really hard to get this award. I asked the deans of every ABA-approved law school to nominate one person. There, in this last round, almost 90 deans did. And we have a very fancy committee. Actually, Howell Jackson is on this committee. And a committee of roughly a dozen very fancy people like Howell, academics, judges, practitioners. And they do a first cut of these almost 90 nominations. And then we get together in the chambers of the chair of the committee, Justice Tino Cuellar in the Supreme Court of California, and we spend the whole day discussing all of these articles. And you know, it's a tough group. It's hard to get consensus in this group. But at the end of the day, it works. And as I said, there were, in this last round, which is the 4th round of these awards, there are sort of 8 awardees in the history of this award. Dan Schwarcz was one of the winners. And the winner gets recognized at the annual meeting. They give a short talk about their work. Justice Cuellar says nice things about them. They get a check and a plaque and those nice things. But we also organize a conference around their work as a way to bring more attention to it, to think of extensions, to just talk about issues that the ALI Early Career Scholar Committee thought were interesting, which is why one of the reasons why they made this decision. So this is why we're here today, to discuss work that's related to Dan's accomplishments. And I'm delighted that you're all here. You're all a super distinguished group. I know we'll have super interesting conversations. And before actually getting to the first panel, my wonderful colleague, Stephanie Middleton, who is the Deputy Director of the ALI, and Stephanie and I are partners in crime in all of these things, this project, and then the 18 ongoing substantive projects that the ALI has going on now, including a related project, the restatement of liability insurance. Kyle Logue, one of the reporters, is here. This is a project that we will come to its successful completion at the annual meeting in May. So that's one of 18. So Stephanie and I work really closely together on the 18 substantive projects, and then on things like wonderful things like the Early Career Scholar Program. So Stephanie will have a few words, and then we'll get started. Thanks.
So thanks everybody for coming, and for Dan. Dan did a great job organizing this. Some young scholars are better than others, and he gets a prize for pulling this together. Couple things. We are recording this video, so be careful what you say. We're not sure what we're going to do with it, but just wanted you to be on notice. The other thing I wanted to mention is Kyle Logue is here. Tom Baker couldn't be here, but we will be hopefully wrapping up the restatement of liability insurance in May. It usually takes us a couple to several months to edit it after it's been approved by membership. And then it gets print and bound, and so it won't be on the market probably till the end of this year. But you all are thought leaders in the field, and I would encourage you to talk about it, put on programs, bench bar, or things at the academy, whatever. We will help you, send you parts of the draft as it's being edited. It is copyrighted. We'll give you permission to use it, but I would encourage you. We want the courts are already citing it in draft form, so it's pretty well known that it exists, but I would just encourage all of you to use it, and we will help in any way we can. And I want to just thank Kyle and Tom for the tremendous job they've done. It's hard to be a reporter, much harder than anybody realizes when they say yes. And they put out their draft initially the way they want it to be, and then the ALI process changes it. Probably in many ways they don't want it changed, but they've been gracious through the whole thing, and in the end, it's going to be very influential, I think, and the courts will be relying on it. So I want to thank Kyle, and Dan is an advisor on that project. Many of you are, so this is a little bit, and it's just by coincidence that Dan won this award. It's a celebration of the completion of a really good restatement project. So thank you, Kyle.
Well, it's really exciting to see you all here. It's a bigger room than I thought, and so we may have to stretch in the middle at some point. But I want to first thank everyone at the ALI for just being wonderful to work for and so generous in helping me put this on, and in the process of over the last year of coordinating an event like this, and that includes Stephanie, Ricky, but also Catherine Grazianelli, who can't be here, unfortunately, Stephanie Zuba, Judy. So I just really appreciate all of their work. And I also really appreciate all of you coming. It's a little bit odd that everyone's here, and I pretty much know everyone. If I don't know you, and there are few people in the room, I hope that at some point you'll introduce yourself to me, but for the most part, I know all of you, and so there's a weird way, and I was remarking about this last night, it's a little bit like my wedding, though I guess there's not going to be any cake or dancing. But the larger sort of goal here, and what I was really trying to get at, and one of the things I've tried to do in my academic career is cross over silos. So obviously, most of what I do has to do with insurance law and regulation. But on the academic side, I've always sort of thought about myself as being a bit more diverse than that in terms of what I'm interested in. So I think about contract law, I think about financial regulation, I think about regulatory design, I think about financial regulation more generally. And so I've always tried to sort of work across those silos, but then also outside of legal academia. I've often found that there's actually a lot to be learned about insurance law and regulation from other academic disciplines, from economists, from psychologists, and more than that, there are so many people in the real world who are dealing with the issues that come up all the time in academic writing. So whether it's at the federal level, at the state level, whether we're talking about policymakers or folks in think tanks, the universe of people who deal with insurance law and regulation in one form or another is massive. And to me, it's unfortunate that there's not as much dialogue across the traditional silos with respect to core issues as there ought to be. Because in a lot of ways, we're all thinking about many of the same issues, but we don't all know one another. So one of my goals here, and one thing I hope each of you will do, every one of you, I would say, has someone here who you don't know, but who is interested in the very same things you're interested in, but works in a different silo. Whether you're a law professor and there's an economics professor, or whether you're an economics professor and you're a regulator at the state level, or whether you're someone who's in a think tank and you're talking about law. So I challenge each one of you to try to meet someone and find someone who is interested in similar issues, but maybe you have not previously encountered because of the siloed nature of the academy and the regulatory and policy world. And that's really one of the things that's motivated me, and one of the things that I hope, more than anything else, each of you gets out of this conference. I want to, in just the short time that I have, talk a little bit substantively about why it is that I chose the 4 panels that I did in terms of the topics that they'll be covering. And obviously, I'm not going to be able to get in depth on each one of them. I'll probably talk a little bit more about the first two, because I'm going to come back as the moderator of the third panel. So you'll get to hear from me a little bit more at that point. And then after that, I'll introduce our keynote speaker, Roy Woodall. So the first panel, and we'll hear from it right after Roy's remarks, is about the relationship of federal and state level government in insurance. Now, of course, all of you know this is a perennial issue in insurance law and regulation. All of you know that the states play a uniquely important role in insurance law and regulation. And probably many of you know that over the last decade, but frankly for many, many, many decades, the role that the federal government should play in insurance regulation has been a very controversial subject. The states are obviously protective of what they do, and in many ways they do their job very well. But one of the things that I've written about, and I do believe, is that we saw in 2008 that there are certain types of issues with respect to insurance companies that require some federal level intervention. We saw in 2008 that there are companies that are insurance companies, but that aren't doing what traditional insurance companies do, and that can pose larger risks to the financial system. So AIG is obviously the poster child here, but it's not just AIG. Many insurers suffered severely during the crisis, took bailout funds. The financial guarantee insurers were very much involved in the 2008 crisis. And the types of activities that AIG was engaging in, though some of them had nothing to do with insurance, at least as technically understood, credit default swaps were engaged in by AIG Financial Products, which was not an insurance company. But at the same time, other elements of what AIG found themselves in trouble in did involve insurance. And so the clearest example there is one of the real problems that AIG had involved their securities lending operations. And those securities lending operations involved taking the assets of the insurance companies and lending them out. So in a very important way, it's actually quite common in the insurance industry to engage in securities lending. And it's not just securities lending and credit default swaps that raise potential problems. More and more insurance companies are relying on short-term funding, which can create run risks. More and more they're engaging in providing products that are linked to financial markets that potentially have some optionality about when policyholders can withdraw. And so all of this means that there's, at least in some cases, the prospect for insurance companies to pose systemic risks. Now, to the extent you accept that conclusion, and I think that conclusion is relatively unassailable given what we experienced in 2008, it's my belief that the necessary corollary is we have to have federal level involvement in insurance regulation. And the reasons for that are, I believe, multifaceted. But probably most fundamentally, the nature of systemic risk is that it cannot be contained within a state jurisdiction, that it spreads across the states, across the financial system, nationally, and even internationally. And so for that reason, the federal government is the entity that's going to have the best scope into that problem, and frankly, the best resources and incentives to deal with that problem. So to the extent that you accept that as true and you think that that's reasonable, the question becomes, how should the federal government be involved? And that's an issue that, of course, is changing right now and I think is very difficult. We have seen that defining exactly when insurance companies become systemic is not an easy thing to do. And in fact, I would say that none of us know for sure exactly where the marker is or exactly how to define that. And if we're going to have an intellectually honest conversation, we can say, look, we know certain markers of systemic risk, we know certain things that raise this prospect, but we can't define it precisely. And given that, the designation of individual insurance companies has naturally raised a lot of concern and a lot of consternation. So that's one set of issues we're going to be hearing about a lot in this panel. Should we be designating entities? Should we more be looking at activities of insurance companies? Or should we be designating insurance companies on the basis of their activities, which is yet a different formulation? Briefly, because I'm already running out of time, I want to say something about rate regulation as well, which is going to be our second panel. So, as you all know, the regulation of rates has been a fundamental issue in insurance regulation really for the last century. What I think is less appreciated about that is if you look at the historical origins of rate regulation, what you tend to see is that it arose actually out of the conceptualization of the property and casualty insurance industry as a natural monopoly. And a lot of the sort of same concepts that were used to regulate natural monopolies, regulating rates on the basis of cost, making sure that there's a fair rate of return by having regulators that engage in a rate review process, derive from that historically. What I would contend, and I have contended in recent work, is that that model no longer fits. And it results both in overregulation and underregulation, in my view. So with respect to overregulation, it's my view that attempts to regulate insurance rates to prevent them from being excessive don't make sense. That approach derived from the view that there wasn't competition among insurers because they all had to charge the same rates, because they were all using the same data and information. And if you look at how the market is structured right now, the fact that insurers share data does not, and frankly could not, lead to any type of price fixing or antitrust concerns. And so the notion that we should devote extensive regulatory resources to ensuring that rates are not excessive is, in my view, not sensible. At the same time, the actual prohibition against unfair discrimination in insurance also came from public utility regulation. And in the public utility space, what unfair discrimination means is not what we normally think about as discrimination right now. It's not you're discriminating against a discrete group, you're discriminated against a discrete class of minorities. It's that you are charging people a rate that doesn't reflect their cost. And so generally, the way that states think about unfair discrimination is there an actuarial basis for the rate that's being charged? And I would maintain that that's not really the pressing policy problem that we're facing today. Instead, what I would maintain is that the reason why discrimination in insurance should bother us is not because there's not enough competition, but because there's sometimes too much competition that results in classification structures that end up having systemic consequences with respect to how certain discrete groups in our society are treated. And that's an issue that traditionally, I would say, has been largely ignored in insurance regulation, but that ought not be, especially with the advent of big data. The questions about why people are charged higher or lower rates and the extent to which the reasons for that end up being proxies for things like race, or things like income, or things like gender, is really something we have to confront head on, and we have not. And I think that's a problem as well. And so we're going to hear a lot about that in our second panel. So as I said, I will stop there because you'll hear more from me at the start of the third panel, and I'll talk a little bit about setting up the third and fourth panels at that time, which will really take us from insurance regulation, which is the morning, to more insurance law in the courts, which is more the afternoon. And that's the basic, if you want to conceptualize the conference. This morning is insurance regulation, the afternoon is insurance law. But for now, it's actually my great pleasure to introduce our keynote speaker, Roy Woodall. Now, Roy, until a week ago, was the independent member of the Financial Stability Oversight Council with insurance expertise. That's quite a mouthful in terms of a title. But he was appointed by President Obama in 2011 to be the independent member. He had played an important role in the designation of individual companies as systemically significant. And before he was the independent member, he actually was himself a state insurance commissioner. He worked on behalf of industry groups. So Roy has spanned the state side, the federal side, the industry side, the regulatory side. And more than that, one of the reasons why I'm so excited to welcome Roy as our guest speaker is, in my view, he's really been an intellectual thought leader with respect to the question of how should we designate. Roy, Roy and I don't see eye to eye on this. Roy was a dissenter on the decision to designate MetLife as a systemically significant insurance company. And one of the points he made in his dissent, and I think quite powerfully, is that we need to think more about the activities insurance companies are engaging in when thinking about their designation, and less about sort of this gestalt, holistic view of they're big and they do lots of things and we're going to describe them, that we need to be more analytically rigorous. And my view is that there's a lot of sense to that. At the end of the day, I do think that the MetLife designation was appropriate, and I got many of you to sign on to an amicus brief defending that designation, which was subsequently rendered moot, of course. But nonetheless, I learned a lot from reading Roy's dissent, from chatting with people in his offices, and he's a man who I admire greatly. So I'm so pleased to welcome him here. The other thing I will say is, in my view, we're particularly lucky to have Roy at this moment, because as of a week ago, he is a private citizen, which means that he can say whatever he wants, and no one's gonna hold it against him or censor him in any way. So I look forward to hearing the true, uncensored Roy Woodall with the gloves off. And with that, I will turn it over to Roy.
I may get wound up and you'll have to blow the whistle to stop me. I had such a wonderful time last night. I got here about an hour before the dinner and sat at the table in the bar with Dan and a bunch of the professors, and it was a very stimulating conversation. And I went back and looked at my little study, and I've still got 3 unpacked banker's boxes of my souvenirs and relics from about 15 years in federal government. And so I thought, well, I'm going to take some of those with me. And the first thing I thought about was what I'd take them in. And I don't know, does anybody know what this is? Bill would know, and I think Brenda knows. Dave probably knows. I think they stopped giving these about 20 years ago. But you'd check into the NAIC, and you'd get this vinyl folder with all the stuff in it, and all the meeting changes and so forth. And you'd have to lug this thing around the whole time. Whereas now you go in and you put it on your computer and you don't have anything to carry around. But we had a house full of these, and I think that this is the only one I have left, and I figured that that would be my first relic. And I also thought a little bit more about what to say, because Dan's kind of given me an introduction, and it's always hard to live up to introduction, but I guess if you had a title, you might be Ramblings of an Old Man. Because I've been in insurance for a long time. My granddad, Woodall, was a 50-year veteran with the old Equitable of New York. My dad had an agency in Kentucky, general agency. When I was in high school, I used to go down in the summers and type the policies. And I don't know if you remember those automobile policies, and they were about that thick. And they had about 7 or 8 carbons, and you had to really hit the keys hard to get the stuff through all the carbons. And that's what I did. And when I got through, my dad was ready to welcome me back to the agency, and I thought, I don't want to go into insurance. I went to law school. And it's Terry Vaughn, a good friend of mine, said, my detour became my passion. Because in law school, the second summer, I guess, I had a summer job at the Kentucky Insurance Department conducting agents hearings, and got a little taste for the very first time of how the regulatory system works. So when I finished law school, the department asked me, to come, and I worked for a while part-time as an attorney, but over 4 years I became the general counsel, went through 4 commissioners in 4 years. The last one got fired in the middle of a rate hearing, which is another story. So anyway, I was appointed in '67 as the commissioner. And it was a very interesting time. And after that, I practiced law in Louisville for several years. And then we had some seizures of insurance companies, and I ended up as a rehabilitator of 3 insurance companies. Then, after that, I got involved more with the trade association side of it. I moved to Atlanta and became the head of the National Association of Life Companies. A lot of you may not have heard of that group. It merged with the ACLI in 1992. It was based in Atlanta, as I said, but we moved it to Washington in about '85. And the reason we did, no one came to Washington for insurance issues back then unless it was tax. And the '86 Tax Reform Act was a big deal to insurance companies, a really big deal. And if you were around then, you remember the stock mutual fight, which just went for years before they ever got to anything. And I think time only cured it when most of the mutuals became stocks. But that's what kind of brought us to town. And we found out that really there wasn't that sort of repository of people who had any sort of state regulatory experience. So it kind of put me in a position of being at the right time, at the right place, I think. Because when in '98 I retired, I went with another law firm for a couple of years, and then 9/11 hit. And 9/11 changed my life the way it changed a lot of people's lives, because no one knew really what to do. And they wanted to try to get the Terrorism Insurance Act, the TRIA, going. And there was a lot of negotiation about it. And I did some pro bono work for one of the representatives in Congress that was on the Financial Services Committee and was in charge, really, of the terrorism issue. And he said, we can't really pay you, and we can't expect you to keep doing pro bono. So he called a friend of his over at CRS. Now, I don't know if a lot of you know what CRS, Congressional Research Service, Baird Wavell is here today from there. And they said, well, we don't have anybody. We have somebody that does flood insurance, but we don't have anybody that does any other insurance. So I went to CRS and started doing the terrorism insurance stuff. But then here came the optional federal charter issue. And that was hot, and people were wanting to get done with that. And what the CRS does is to issue both memoranda and reports, and I brought some of these. Here's the one I did in 2002, on optional federal chartering for insurers, legislation, and viewpoints. That would be used to go brief members of Congress. And it's a real resource, and it was always private. It's only for members of Congress. Now, I read recently that one of the bills made all of that public. Did it pass, Baird?
Yeah, it was in the appropriations bill. We've got 90 days to put out a report on how the service is going to do it. And then I would expect to see a public website in the next 6 months.
Well, a lot of these...
It's the government, maybe a year.
Yeah, a lot of these, even though it was not public, they would end up on the internet. If you enter my name or something, you'll see some of these old reports will pick up. And it was it made me think to say a little bit about it, because last night I had some questions about, well, what about OFR? What's going to happen to OFR? What about the research? OFR, I think, is in trouble. Their employee base has shrunk sufficiently, I guess at this point, maybe not sufficiently, it'll probably continue for a while. And it was set up to really serve FSOC, and the members of FSOC to help do a lot of the research for them. And my own experience, which I can now speak because I'm a free man, when we were going through the designations of insurance companies, the OFR didn't have one person that had any knowledge and background in insurance. And it was very frustrating. I finally got a person that knew systems and data, done a lot of work for the NAIC, and got him on contract for a while. But then pressure ended that. So again, I kind of lost some help there. But as far as the CRS, that kind of led to Treasury, because when the terrorism bill did pass, it was given to Treasury to implement. And so the people that I'd worked with at Treasury during the time that the legislation was getting passed said, why don't you come over and help us implement? So I went over and worked on the very first temporary regs that went out. And then at the end of the year, it was a one-year temporary. They said, well, why don't you stay another year? And by that time, we were getting optional federal charter issues, like the report that I had done before. And so it ended up that I stayed at Treasury for 8 years as a one-year temporary, and then was appointed to be the first independent member on the insurance seat there. So maybe kind of pull this together. I don't want to take up all my time. I hadn't even gotten off my first pages of a note yet. But the Dodd-Frank thing, I was there when all that happened. I was there when the crisis happened. I was there when Dodd-Frank, we participated in Dodd-Frank. Tom Glassick is one that on the Hill that we worked very closely with, knew the insurance issues. And as far as what happened in Dodd-Frank, a lot of people don't realize the situation that happened and how this position was ever formed. They got all the financial regulators, and they wanted them at one table in one room, and that was a good idea. And then somebody, after the bill had already passed one of the chambers, said, wait a minute, there's no insurance person in there. And insurance is too big a factor of our financial system not to be represented on FSOC. But of course, it was state regulated. And so they didn't know really and there was a lot of discussion. Well, we ought to have a state regulator, and it makes a lot of sense. All the others sitting at the table are regulators. But there was a problem that some said was constitutional. Others said, well, it just doesn't sound right. How can a commissioner take an oath of office and swear his allegiance to a governor, and then also take an office and swear allegiance to the president? That puts him in an odd position, and that kind of stuck with me. How does that really work? And the other was, well, let's use the file, because that was created in Dodd-Frank. And the answer on that was, well, but the file is not independent. It's under Treasury. That gives Treasury 2 votes. So that won't work. So at the very last minute, they came up with the idea that have an independent member, and they just have 3 sentences in the law. And one is that the title says insurance expertise, which is a terrible title. And it gives no duties. It says that he has to be appointed by the president, confirmed by the Senate, and what the salary is in the category. And that is all that's there. There are no provisions for what his duties are, where he would be, whether he'd have a budget or she. No budget provisions. They're going to have employees. So when I first showed up, I didn't know really where to go. I didn't know how I would get paid. I didn't know whether I would have any help. So it took several months just to negotiate getting that set up. And it's been a real ride, and it's been a great situation. And last week, when they swore in Tom Workman as my successor, I was there. I've known Tom for almost 40 years. When I had that group in Atlanta of smaller companies, he had the Ohio Association of Insurance Companies. And about 16 years ago, he went to New York and was head of Lyconi, and just retired from that about a little more than a year ago. So I don't think we could have had a better situation. I've had him over. He's met the staff. I ended up with 3 staff people. I have a lady from the Fed, Diane Fraser, and I have Charles Klingman, who was a Treasury person and an administrative person. And the three of them are technically Treasury employees, but in their job description, they report to me. So that's one of these awkward things that we had to get worked out. I am on the Treasury, or whoever Tom Workman is too, on the Treasury IT and computer systems, and yet he has to be independent. It took me a month to get an email address of Roy Woodall at fsoc.gov rather than treasury.gov. Because I said, how can I be independent? And what does someone think when they get something from me and it says Treasury? So there's a lot more to tell, and I wish I could get into a lot of the things that we've done on the designation of companies. I will say one thing that I had mentioned in most of my dissents, of my concern on the international basis. And I'm glad to see that Mike McGrath has come in here because it put us kind of at odds. Mike had a situation where he had specified duties under the statute of what he was doing, but he had no vote on FSOC. I have a vote on FSOC, but no duties. So this sets it up for tension, to say the least, as to how do you work that out. And there were some contentious times, and especially on the international level, because I was taking the position that all members under Dodd-Frank are supposed to monitor international developments. And so I thought that was the key, just as a member, that I would be able to do that. But we ended up with a situation where when we went to FSOC, I was a voting member, Mike was the non-voting member. Then we'd go to the IAIS, and Mike was a voting member, and I couldn't get in the room, essentially. It's what it really amounted to, and that's where, the struggle had come. And I don't know if that will continue, but it wasn't anything personal. It's just the idea that you've got a conflict brewing just from the way the statute was written. But the international part bothered me, and it became more and more real to me, because why, for instance, were the Republicans, it wasn't just politics. I don't think that they were after what the FSB did and what the G20 did. It really kind of came down, one of the papers that helped me a lot, and I mentioned this last night when we were discussing, it's a CIGI paper number 42, was put out in September of 2014 by Malcolm Knight. Malcolm Knight was with the IMF for a long time, and he made this distinction, which I think is very valid. He said the problem is that FSB and G20 are not statutory creatures. The way World Bank and IMF. They were not set up by Congress. Congress doesn't fund them. Congress doesn't have any oversight on them, and Congress doesn't like that. And that is really the guts, I think, of the whole problem. And what we had happen is that when I first got there, the GE Capital, the only non-insurance company that was designated as the SIFI, was first, and then we worked on AIG, and my office was very active in that, and all the documents that were done on that, and I voted to designate AIG. And a little shortly after that time, the FSB designated AIG as one of the global SIFIs, or the GSII. And that's kind of the way I think it was intended. Then when we got to Pru and MetLife, two companies that really hadn't caused the kind of problem that AIG had done during the crisis, and they were coming in, there were three people sitting on FSOC Council, the chair of the FSOC, in other words, Treasury, the Fed, and SEC. And they were what Professor Knight would call self-appointed. And they had gone to an FSB meeting and by consensus, that's the key word, agreed that along with the 9 international companies that were global SIFIs, that the Peru and the Met were global SIFIs. And part of that consensus was the consent that you would follow through with what you're supposed to do, and that is to implement what the international standards group was trying to get out. And with a very good cause. I mean, they were coming out of the crisis. They were trying their best to get something done. They probably didn't want to get bogged down in legislation. And so they were trying to do the best they could. But what happened is that 3 of those members consented that Peru and Met were global SIFIs. Now, if they're global SIFIs, how can they not be national SIFIs? And I think that this gut-wrenching distinction in here is what shaped a lot of my thinking, because I just didn't feel that it was right. I didn't think that the analogy and the analysis and all would really prove that. There was one quote I had back in my notes, but I haven't even gotten into that I wanted to mention, is that if you think, well, maybe that's not what they're supposed to do, Mark Carney, who's the head of FSB, has made this statement just recently. He's the Bank of England governor, that full, consistent, and prompt implementation of agreed reforms is essential to maintaining an open and resilient global financial system. So the idea of these had to be implemented. Now, they couldn't be implemented essentially by the states because the states couldn't do it all at one time on a consolidated basis, the way that this was intended to be done. And so what was the way? Well, designate them, send to the Fed, then you've got consolidated regulation and you have upheld your commitment and your agreement that you're going to make these companies be under a consolidated group, however you want to call it. To me, I think we call it group. And what they mean in Europe by group is kind of what we mean by consolidated, because you've got to have more than just the insurance entities involved. Now, I think one of the biggest things, and I'll try to wrap up for a question or two, one of the biggest things we've got ahead of us right now is what the NAIC is doing with its, this is where they're talking, it's financially Stability Task Force. Now, that's a task force that's being chaired by Mr. Hart from New Jersey, and I think he's done a very good job, and the whole idea is to try to have a macro-prudential initiative that would allow the states to regulate on a group-wide basis, where they would be able to do what the rest of the international community expects some regulator in this country to do. Now, you'll hear from Tom Sullivan later on about what the Fed has done, and thank goodness Tom was at the Fed, because when he got there, it was the first time a lot of those people really understood that banks and insurance weren't the same creatures. And my hat's off to Tom for all the work that he's done. But in the meantime, the way this designation thing has fallen out, Peru's the only one left. I think with this new administration, you're not going to expect to see any new designations. So the things are going to be changing, and it's the time, in my estimation, for the state regulators to really come to the fore, to get together and have a system growing out of this task force where they can say, yes, we can regulate financial stability in this country. Because I think if they don't, the next crisis that comes, it's not going to be like the last one. We don't know when it's going to come. When it does get here, and they can't do that, then I think it's going to be right back to where it was before. There's going to be either international pressure or national pressure that you're going to have some way to have national consolidated regulation on these, especially these larger companies. I haven't said everything I'd like to say. I haven't even shown you all my souvenirs. One I wanted you to see, especially some of the good work that's being done by the Bipartisan Policy Council. They came out in April of last year with this report. If you haven't seen it, it's called Improving Insurance, U.S. Insurance Regulation. It's on their website. And Justin Chardon, I think, is here today. He was a staffer on that. Bill was a member of the task force that did that. And my hat's off to that group. I think it's the most comprehensive thing I've seen in the last year as far as trying to say, how do we move toward that? Because they consider a lot of these problems, and maybe you'll be discussing some of those in your group. Let me take one question then, if I hadn't taken up all my time.
All right, well, I guess we have time for one question. Maybe I'm going to take it. So, in your dissents to MetLife designation, you emphasize that you would have liked to have seen an analysis of the second designation standard, which looks at the activities of companies instead of whether or not their failure could cause material financial distress. And that makes good sense. But I'm wondering if that is different than the way that currently people are talking about the activities-based approach to systemic risk regulation. Because the way you talked about it in your dissent, my understanding was that you were talking about, we'll decide whether or not to designate an entity by looking at its activities. By contrast, my sense of how folks are currently using activities-based approach and how the Trump administration is approaching that is, we're not going to designate anyone, irrespective of their activities. We're just going to look at regulating activities across companies. And so I'm wondering if you do think those are distinguishable, different, and to the extent they are, do you think that it's sensible to completely, just as a policy matter, abandon the idea of singling out individual companies that, whether it's under the first or second designation standard, could potentially pose risks to the broader financial
Yeah, those are good questions. There are lots of questions in there. I didn't get into these standards. I think most of you all know that you've got the two standards. I tried to get the Secretariat at FSOC to look at the second standard. They felt that the first was sufficient, but I insisted that at least they put in the documents, the basis documents for the thing, that they based it clearly only on the designation on material financial distress and not the activities. And I did. I don't think I had a very clear activity approach in mind. And obviously, as you mentioned, you've got kind of two things. My thought was that they're really not opposed. Your paper talks about the threat. And I think if you had a company that was designated because of an activity, by golly, I don't think any other companies are going to be engaging in those activities. So whether you do it on a one-time basis or the other. Now, I firmly feel, and I'm so pleased that the new administration has taken the position that it's not going to get rid of the authority to designate. I think that that is crucial. We don't know how the next crisis is going to start or anything else about it, but I hate to give up, as Hank Paulson said, the bazooka in my pocket, to be able to address something like that when you don't know. I mean, it may never be used, but to have it there is a protection, I think, because if you don't, you can't get it done. The Fed had a bad experience. What they used in their toolbox to really almost the key thing in the whole financial crisis, Congress took away from them. So, I don't think that you want to get in a situation where you let something like that go. And I know that Mnuchin and some of the members of this administration have been highly criticized because they didn't want to get rid of it. It could be that there could be some legislation coming through that would do it. But I do feel that having that authority there, if the facts presented could be solved only by using that, that it should be there. I don't think there are going to be more designations for a while. I think that We don't know exactly how this administration is going to be coming. It's interesting to me that the last year and a half that I was there, it was a new day. It was the whole new Trump administration. And I can say that things are different. There's some good things, some things that are not so good, but one thing that I found interesting is that the meetings are not scripted. And that's kind of a relief. The meetings of the old FSOC, where every voting member, runs a huge agency. He's got all this staff, and he's got his comments written out, and they all read their comments. If you've ever watched a Federal Reserve Board meeting, it works the same way. Everybody reads the statement. And I can tell you that's not the situation right now. There have been some very heated discussion, impromptu, that nobody even intended to say anything when they went in. That said a mouthful. So that's a good sign. So I think I better stop. I don't want to run your program long, and I'm sorry I didn't get through. I'm planning to be around the rest of your day. I've done some of your sessions in the past. I enjoy them, and I don't have anything better to do as a retired man. So I'll be around, and if you do have any questions, please come up and ask me, and I'll be delighted to talk with you. Thank you very much.